Hey guys, this is Oliver, and I'll be doing a quick analysis on QRTEA. At the moment, I will be I'm about to go hiking, so it's going to be really fun. So let's start real quick. So, big summary for Quora. They're very undervalued. They're trading at a 2.34 price per free cash flow, or like a 47% yield. 42.73% free cash flow yield. I've never seen a company trading this low before. Every single metric there undervalued by PE. Trailing per 12 months, we got a 4.49 ratio. Forward yield 7.81. Price per sales. I got food in my mouth. Sorry. Price per sales is 0.38. Price per book 1.47. EV per EBITDA 6.29. Their free cash flow of 2020 is $2,198 million and $959 million last year. This was a very exceptional year for them. They're an online retail service. So a lot of people think this is because COVID, but they had a very bad year in 2019. Current price is $12.51. Their market cap is $5,138 million or 5.138 billion. Yeah, okay. Price per free cash flow from their 2020 yield is 2.34, as mentioned before, but by 2019 standards, it's still undervalued with 5.36. This company continuously does share buybacks. And this is a statement from the manager. Our performance enabled us to increase shareholder capital return. We resumed share repurchases. We bought 7.7 million shares, and they even created their own special stock that distributed an 8% dividend. At the moment, that's QRTEP, if any of you guys are interested in. And let's do this real quick. We are looking at a 7.91% dividend. Dang, I got so much eggs in my mouth. Sorry, boys. So if we're looking at this, they're distributed pretty well. They're diversified. But one of the greatest parts about them is, I'm trying to find the chart. Maybe not this one, but they have a 90% customer retention rate. I believe it's on one of their events. I believe I posted this on the Joseph Carlson Discord, but also I'm part of a different Discord for my high school, and I post things. There's a high customer retention rate of nearly 90%. This is a company that kind of sells retail products. They sell clothes. They sell fashion. At the moment, furniture is their biggest thing, and home products. And it's kind of this service where you have this like TV advertisements, and customers watch these like 30-minute ads, and they're willing to watch it. So this is a very niche community, I'd say. And I'd say that gives them a moat, actually. But what they can do is they integrate social media with that, so you can talk to the advertisers who are advertising this live. I could say this is a dying industry, and I guess I would agree with that. But also, if we look at like their demographics, 35 to 65-year-old woman, as we can see, this is a generational thing. And the thing about generational things is it takes time for these changes to be made. For example, like the big banks are not going away anywhere. I don't believe that, because a lot of people are used to having all their money in Chase. That generation is probably going to keep their money in Chase for the rest of their life. And same thing with this. I mean, if people are still shopping here when Amazon still exists, I don't think they're going to go away. I think there's a certain type of people that enjoy seeing these advertisements, enjoy like seeing people talking about the products. It's kind of like the 50s when you had these like more complicated ads, and now all the ads are short. Some people enjoy that. So I'd say that's a moat, believe it or not. Maybe this isn't the best company, but I believe that for its current evaluations, I believe this will give any investor a very good margin of safety. And I think it's very difficult to lose money from this company, especially because they're doing so well this year. And even by 2019 standards, they're still incredibly undervalued. If we look at stuff like their PE ratios, and this one's a little off on Zach's research. It gives us a 12.13, but as we can see on Yahoo Finance has a very similar answer as well. They have a 4.37 at the moment, so they are record low PEs for the last 10 years. It's incredible. Their free cash flow generation has only gotten higher. Even if it reverts to their old levels, I believe they'll be fine. I believe they will be completely fine. Here's a short summary I made. I just believe the cheap. This is a generational thing, and given their high retention rates, as they said, 90% retention rates from the same customers, I do not believe they will be going anywhere. And I did some analysis on them. This is Hamish Holder's DCF, but I've heavily modified it. I've added a bunch of stuff to it. But I really like his format, so I've kind of just kept it. Maybe later. There's some issues. There's some negatives with this company, but there's no negative large enough for me to just discount them. I guess the biggest one is their current ratio is 0.97, which is unfortunate, and their debt to equity ratio is 3.55. But I believe given this huge margin of safety, I mean, once we reach the DCF valuations, you'll see what I mean. I believe that this can be discounted. This can be discounted a lot. Their average PE has been 14 in the last 10 years, and their average price per free cash flow has been 18.27, which is drastically above the current price we're at right now. In addition, only 33% of their debt is due in the next 4 to 5 years. And I think that's huge because this isn't a long-term company I plan on holding. This is a company is kind of like a cigar butt company. I wouldn't say it's a shitty company. It's consistently been increasing. If you look at the free cash flow, it's been maybe not the most consistent, but it's still been going an upwards trend in the last 10 years. Whether this will continue or not, I don't think it even matters, just because even if it goes back to 2019 levels, we see it's still cheap. And if we're going to count 2020 as like, oh, this is a one-time occurrence, we could say 2019 was a one-time occurrence as well. I generally don't. I think this company is fine. I don't think anything will go wrong with them. I think it'll be very difficult at the price you're buying at the moment to actually lose money on this company. Look on return on initial capital, not the best, below 15%. Usually I don't like companies like that. 2020 was a good year though. If we look continuous cash flow growth, which I'm very surprised, and sales growth has been decent, 4%. It's pretty good. It's more than MO. That's one thing. So if any of you guys really liked MO, remember MO was growing slow, but MO was becoming more and more, had a better ROIC and stuff like that. So if we look at simple DCF analysis, I mean, every single one shows that this is, I mean, the stock is at $12 and this is after debt, and they have a $6,130, $30 million in debt. This includes short-term debt and total long-term debt. And I added back the cash, so I discounted that. And remember, only 33% of this is due. But I included all of it just to be conservative. And even with this conservative evaluations, I mean, even at -2%, we're getting 23.91. Then for this model 345, I edited this slightly to make it 4 years because I was thinking, hey, I'm only going to hold on to the stock for 4 to 5 years. So let's use how much this model. And I also did a terminal growth rate of 0% just because I don't know what's going to happen to this business in 20 years. This business might go away in 20 years. Like I said, this is more of a medium-term investment. And if we look at this at 0%, I mean, it's doing great. Even at -2% in 10 years, 23. And if we do something like -2.5%, like every single year it's losing cash flow, we get to 2064. And the current share price is $12. Now, it's a little hard with DCF because they have this preferred shares, and I was a little uncertain how to calculate that because the preferred shares, I originally was going to subtract the market cap of the preferred shares. The issue is, unlike a company like Google, which has Goog and Google, you can just add the shares together because the share price is pretty much the same. Their preferred shares is around like $100. So what I did was I just treated all of them as equal. So there's a little bit of that, but I think this company's still going to grow at 2.5%. I don't. I mean, this is very conservative considering they've had a 13.67% free cash flow rate. I honestly think this is fine. But if you're worried about that, and if you're thinking, oh, wait, I think they're actually going to be losing money on their cash flow, and I really want something accurate, then an easier way to value them, like I said, every single valuation has them undervalued, is you could take something like their PE ratio and you could take their average. Their average at the moment is 14, so their stock should be 40.04 if we take that average, 220% upside. If we take normal market average, PE 15, like this is what we consider safe. At the moment, the S&P 500 is really like a 33 average, but just to be safe, again, 15, 243%. Free cash flow, if we take fair value, I mean, it's insane, 95.35. I'm skeptical of this. I'm skeptical of this as well. So I took the 2019 valuation, 36.73, and that was the one I believe I settled for. And with a 50% margin of safety, still undervalued. Incredible. Absolutely incredible. 193% upside. I think my plan with this company is I'm going to buy a bunch of shares at the moment, and I believe I will sell once it reaches fair value. But I will be checking this company every single year. And if stuff changes, if the company starts improving, starts adding new things, I will be happy to hold on to the stock. This could be a potential 10-bagger. I am very impressed. And I have not found a single good reason for why it's undervalued, considering that this is literally their best year. Their very best year of performance. And even if you look at the stock, what's it called? Performance, I mean, they've already had a 190% gain, although this doesn't really matter in analyzing business. But some people might be skeptical. Will this continue? I believe it will. And another interesting thing is, for those of you who follow Michael Burry, this is his, I believe, 7th biggest holding, or 1, 2, 3, 4, 5, 6, 7. Yes, he has around $7.7 million in this. And he's recently sold some, I believe, to buy some Lumen, but the vast majority is still in QRTEA. And I believe he purchased this when it was around $10. So I am very happy, actually, in holding this stock, especially because Michael Burry's part of it too. Yeah, that's my short analysis. If any of you guys have any questions, any comments, any concerns, please message me in the description. And I'm going to go enjoy my hike. I'll see you guys later.